Welcome to the Asset Coach and Tax Strategist YouTube channel. If you're a subscriber, thanks so much for subscribing. If you're a first-time viewer, thank you for spending your time here with us. If you like our content, please give us a thumbs up. For you new folks, Asset Coach Tax Strategist YouTube channel is based on the book Economic Termites. This is a book that I wrote a few years ago talking about taxes, inflation, time, laws, and regulations. Also, I wrote a second book called Farming Assets. Those two books is really what this whole channel is about, addressing those situations and how they affect you and I in our ability to grow our wealth. So, as an asset coach and tax strategist, my name is Robert Wolf. I am the CEO and founder of Terra Firma Business and Financial Consultants and its affiliates. We have a bunch of companies that we've built out this ecosystem surrounding the basis of what we talk about on this YouTube channel. So, if you're not a subscriber, hit that subscribe button. We drop episodes every Thursday. Again, if you are, thanks so much. And let's get into this next episode. So, appreciate your time being here. So today's episode is planning strategy that actually is really misunderstood quite a bit. Also, from an accountant CPA perspective, not that it's misunderstood, but the documentation of it is misunderstood. And so today's episode, we're going to talk about promissory notes. What is it? We have really kind of a three-step for today. We're going to talk about what a promissory note is. We're going to talk about why the IRS cares about promissory notes. And lastly, how to make your promissory note compliant for IRS. Now, keep in mind, this conversation, this episode, this information today really is about if you ever get audited and justification of the steps that you're making as a business from a financial perspective on your financial statements, specifically really your balance sheet, because that's where your loans and debts are on. This is an area that I find that is misunderstood, like I had mentioned before, in a documentation perspective. And so I think this is really important because you're the one that signs the tax return. It's your tax return. When you sign it, you're basically you're swearing that the information is accurate. And so if your business partner, the IRS, ever comes knocking on the door, just wants to have a cup of coffee and talk about business and see what's going on with the business and just add some questions. Most people call it an audit. I like my version better. It sounds a little nicer. But they're gonna send you a letter with questions, and that letter with questions is like pulling a string on a sweater. If you have the answers in proof or evidence, they stop pulling the string. If not, the string continues to get pulled and pulled and pulled. And one of the things ends up happening with more questions opens up more gaps in the planning. And so the documentation process of a business is so vital and so important. And so this is an area that I have found in conversations with hundreds of people, if not thousands, over the last last decade alone, when I really kind of focused and found that this was an issue. We use these in our business, promissory notes. And so let's talk about what it is first. Okay. A promissory note is a legal binding written promise to repay a very specific amount of money, either on demand or at a set schedule. So basically a loan agreement, your mortgage, your auto loan, those are all promissory notes. The promissory note is a lot shorter than a secured loan agreement that you would get from a mortgage company or a auto lender. Okay. Really, a lot of times promissory notes are really they are all between two parties, but from a smaller, shorter, straightforward, this is the point of the loan. Okay. So there's some validity to this promissory note that we need to be aware of. There's a couple parts. The amount. What are the two parties agreeing to as the loan amount? The cost of the loan, meaning the interest rate. What's that going to look like? A repayment schedule. You have to have a repayment schedule. You have to have an interest rate. Okay. And the maturity date really is going to be based on the repayment schedule, the signature of the borrower and the lender, so the two parties. And if there's going to be any collateral in this promissory note, we need to indicate what the collateral is. Okay. Now, the IRS is going to treat this promissory note the same way it treats any other loan. It must look and operate like a loan, period. Okay. It cannot disguise a gift. It cannot disguise a distribution. Now, here's the thing. this leads us to where I say that this is misunderstood from accountants and CPAs perspective. There are many times where we as a business owner will be talking to our CPA and they'll be looking at the accounting or the books and they'll go like, what is this? And you're like, oh, I did this, this, and this. Let's say it was you had taken money out of the business, but you had taken out of the business to fund another business. So it wasn't necessarily a distribution. But the accountant has the opportunity to say, oh, this is either a distribution, which is taxable to you, okay, or it's a loan, which is not taxable to you, but money goes over to the other business, right? So what has to happen in this scenario, in this example, let's say it's $50,000, okay? And so I borrow or I take $50,000 from company A and I deposit and fund company B. There needs to be a promissory note between company A and B. A is the lender, B is the borrower. And there needs to be an interest rate and there needs to be a payment schedule. Okay. And based on the payment schedule will determine the maturity date. And both parties have to sign. Well, Bob, what if I'm in control over both companies? Great. They're both separate entities, legal structures. So they're viewed as independent. And if you're a signer, meaning you're a managing member or you're a president or a director, or you're somebody of authority and representation that LLC or that business is giving you the authorization to go into these types of deals on behalf of that entity, then you're a legal signer, even though you're the one signing both. Okay. They are separate entities. They file everything separately. Okay. That's very important to understand. So you can sign as borrower, you can sign as lender as well. Okay. As long as it's clear as to your title in both, and as long as those entities, business A and business B, both have minute corporate notes indicating that you are a responsible party, that the business is giving you authorization to go into this. This documentation is so important. This is what connects the dots. Why is this so important? Is because if not documented correctly, the IRS could indicate that this is not necessarily a loan from one to the other, that this is actually a personal kind of benefit, and it could be taxable. They can reverse it. Okay. Now, does this happen a lot? I don't know. I'm not in every single audit. At the end of the day, I've never heard somebody who's gone through an audit and get all mad and upset and said, "Oh, the IRS they overturned my loan." It's not what do you hear about an audit? I have to pay taxes, I have to pay penalties, I have to pay interest, and blah 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 blah. Right? So, is this overkill? Not necessarily, because you're responsible here. The buck stops with you. And so let's talk about why the IRS cares about this promissory note. I think this is important. So the IRS's scrutiny is common because there's a lot of times there's loans between family members, okay, where loans from shareholders to their corporations or vice versa, the example I just indicated, loans used to move money without tax consequences. Oh. The IRS likes to check whether the transactions is truly a loan and actually a gift, or is it a dividend? Is it compensation or a way to avoid taxes? So if a loan is not properly documented, the IRS can reclassify it as and assess taxes and penalties and interest on both. Now, if you don't have documentation, it doesn't exist. No matter what you say, no matter what you feel, no matter what your books say, your financial statements may say it's a loan. But if this documentation is not in place, the loan not properly documented, the IRS, meaning the agent, can reclassify it as taxes, penalties, and then they'll add interest to that as well. Okay. Am I clear? This is extremely important. Am I clear? Because your accountant in CPA is not going to do this documentation for you. They may notate this in your financial statements, in your financial books this way. But if you don't have this promissory note to indicate or support that, it didn't exist, no matter what your accountant did. You understand? You're responsible. You understand the severity of this. Now, am I getting in the weeds? Um, maybe, but isn't it in the weeds where we find the issues? Isn't that true? Isn't it fine to be able to have a promissory note template for when these types of situations happen? So let's talk about what this looks like from a compliance. How do we make this promissory note IRS compliant? Okay. There needs to be at least a applicable federal rate, meaning we got to use the federal rate as kind of a baseline. You can't just say, oh, it's a 0.5% or 1%. And you cannot say it's 0%. That breaks one of the legitimacies. There has to be a cost. One party is giving another party money. There's a cost to that, because the party A could be investing that and making a rate of return, or even putting it in savings account and earning 2%. But if there's no cost to it, they're losing that cost. Plus, we got inflation costs, right? So there has to be a monthly rate. Okay. Now, this rate is very easy to be able to connect, because when you look at the effective rate of the loan, meaning the signing date of the loan, you can choose the applicable federal rate of that date. And all you have to do, in my opinion, what I would recommend is notate that. As of this date, as the effective date, the applicable federal rate is X. Now, I always recommend charging higher than the AFR rate. The reason being that AFR rate, that applicable federal rate, is a baseline. There needs to be a cost. Remember, there's inflation costs, there's opportunity costs. That's to legitimize this. Now, if you own both companies, does it matter if there's a cost? This is an expense to the company B. In my example, company A lends company B money. Company B needs to pay that back with interest. Isn't that an expense to this company? Doesn't that get a deductible benefit off of this company? The 1099 or the interest charged above, yes, they'll get a 1099 and it will be interest income. That's the whole point of justifying this and making it as a justification of what this looks like. Okay. So that was number one, charge at least a applicable federal rate. Number two, create a written note with all the essential items. What is this? Well, you need to have the principal amount, the amount being loaned, the repayment terms. Are they fixed installments? Is there a balloon? Is it interest only? You don't have to do principal and interest all the time. You can do interest only. It's your agreement between the two parties that are going to agree to it. So you can create this however you want as a repayment. Your interest rate, plus, whatever that is, like we just talked about, number one. And then based on the repayment terms, there needs to be a maturity date. So you could do interest only for a period of time and then have a balloon payment at the end if you want to for the principal. And then also it really helps if there's any kind of remedy for default. Even if it's between the two parties, it still makes essentially a justification, because especially if you have other investors in company B or even investors in company A. Those investors in either company have the right to have a remedy if one of the companies defaults on this loan. Okay. And then collateral, if there's such a thing. Okay. So let's say in my example, company A is lending company B $50,000. Let's say that was lending it to purchase equipment or whatever. Well, we can use that equipment as collateral in the loan. So if company B defaults, the company goes out of business, company A actually has the remedy to bring that equipment to company A and sell that equipment and or have ownership of that equipment. So even if that business goes out of business, okay, this is part of a strategic plan of valuing assets. Equipment is an asset. Okay. A verbal agreement to all this stuff does not exist in the IRS's mind. You can have the most honest face. You can have the best smile in the world. and the best looking hair and the best colored eyes does not matter. You need this documentation in proof, period. Okay, number 3. So number 1, charge at least an applicable federal rate. 2, create a written note with all the essential items. 3, follow the payment schedule. If you have an accountant or bookkeeper, make sure they schedule this. They schedule the payment. If if they are late, that's the remedy for default, right? If they're late, is there a charge for late payments? Even if it is a company that you own, does not matter. This is what, please help me understand. Please listen to what I'm saying and understand this very specifically. The IRS does not care that you own both of them. What they care about is that you're following the rules as a business partner. Because what they don't want to assume is that you're trying to cheat them. And without this documentation and without this in place, that's the only other thing they can think about. Why else would you do this? Well, it's because I'm trying to grow a business. How do they know that? They don't know that unless you're documenting it. Okay, very important. All right, now follow the payment schedule. So make payments on time, record the interest and principal. So your accountant, your bookkeeper should be able to account for both of these in both companies the appropriate way. No different than any other type of loan that you make. If payments are not made, the IRS may decide it was never a loan. Okay, now if you remember, promissory note is 2 parties agreeing. So the payment terms you get to determine. So if you're like, well, Bob, it doesn't make sense to lend company B money for equipment. And if they're not cash flowing, the reason why I'm lending them money is because they don't have the cash flow to buy the equipment. Okay, cool. Not a problem. Then in the payment terms, they don't pay principal and interest right away. You give them a deferral period. Hey, for the first 6 months, we'll defer payment. The next 6 months, you need to pay interest on the loan, interest only. And starting year 2 of the loan, you start paying principal and interest, and it's caught up on this schedule, and it's all paid off by this date. If it's on paper and the 2 parties agree, then it exists. You can create the payment schedule any way you want. Now, here's the other thing. What if all intentions are great and it's just not working out in this promissory note that we wrote it? Rewrite it. What happens when you refinance your house? The new financial institution, what do? They send money and pay off the old one, and all of a sudden you have a new loan agreement. Write a new loan agreement, but document and indicate why. Why are we redoing this? And this supersedes the previous one, but you cannot just throw away the previous one. It needs to be part of the story and the documentation trail. Okay. Number 4, document the borrower's ability to repay, meaning was there a reasonable expectation of repayment? Okay. What do you need to have? Cash flow. Or indication, like I said, company B doesn't have the cash flow. Great. Your promissory note is going to document that repayment. You're creating the promissory note based on indicating they don't have the cash flow in that first year to pay me everything. So what I'm going to do, company A is going to do, is require company B to not pay payments for this first 6 months. Get your cash flow going. Then starting the second 6 months of this term, you're going to pay interest because there's a cost to the loan. Okay. And that's what you're going to do. And then starting year 2, so month 13th, you're going to start paying principal and interest at this schedule to be all paid off by this date. That indicates a repayment. That's where both parties understand the situation, create the promissory note accordingly, and document that. Even the IRS does this. If you owe the IRS taxes, what do? They allow you to do a payment plan. What do they say? Stick to the payment plan. If something comes up, notify us so we can make notation or make adjustments accordingly. At the end of the day, the lender wants their money back. So they're going to work with company B to make sure that they're able to get their money. Right? That's the reality of it. This is business. So number 5, record the loan on your financial statements. This is the last part. You need to record the loan on the financial statements. Your accountant, your bookkeeper should be recording the principal, should be recording the interest. The signed agreement should be in your accounting documentation as well, because if you ever get audited or if there's ever a question, you want to be able to bring it up. You don't want to have to go, what happened 3 years ago? What did we decide? No. No. If you're doing things right and your business is humming and you're making decisions, you're not going to remember 3 years ago. You're not going to remember 3 weeks ago, right? Things are humming. And this loan, this promissory note is the stepping stone into that. That's what you want, right? You want that assistance. You want that help. That's perfect. Now, here's the other thing. Number 6, collateral is not required, but it does help. So if you know the loan is helping to buy physical something, or there's some kind of collateral that you can collateralize out of company B, you want to do that. You want to do that. It helps, but it's not required, but it does help. And then also the other thing is you want to avoid open-ended or no maturity due dates. Okay. Like I had indicated before, if there needs to be a change in the promissory note, then a whole new promissory note can be agreed upon, could be structured without deleting or destroying the previous promissory note, but indication in the new promissory note why it's being renegotiated, what's existing, and what the remedy is. If we need to change to a new promissory note, what's the remedy? Why did not the first promissory note work? And I would address that in the second promissory note and what the remedy is. What are we doing to fix that? Because even if you own both companies, it's important for the documentation perspective. Again, your business partner to IRS know that you're not trying to do the things that they're concerned about in the very beginning, which is what? Is this a gift? Is this a dividend? Is this compensation? Or are you trying to avoid taxes? Those are the 4 things that they're trying to make sure is not occurring. Okay. So as a good business partner, this is very important to do. Okay. Now, what happens if the note is not IRS compliant? The IRS may reclassify a loan to a shareholder as distribution, so it's going to be taxable as dividends. A loan from a business to its owner, it could be now compensation. A loan to family as a gift now triggers a gift tax reporting. A loan used in a business as immediate taxable income. There could be penalties, interest, and sometimes accuracy-related fines. And a notation of this. Remember, if a string's getting pulled, if you don't have the documentation and proof, the string keeps getting pulled. Okay? And then it may lead to another year review and another year review. And that string keeps pulling. We want to make sure we don't have that happen. Okay. So how to use a promissory note properly? Well, like we said, lend money to a relative, fine. That's not a problem. But the promissory note needs to establish the AFR rate interest. There needs to be a set repayment terms, and you need to avoid IRS classifying this as a gift. So you need to make sure there's also a separate form 709, if interest's below the AFR or forgiveness occurs. This form, the IRS understands things happen and payments aren't able to be paid, right? When businesses fail, the IRS knows that. They know that before us. They know all the businesses that fail, right? They're the ones that give us the statistics. So of course they're going to have a form. Okay. Number 2, shareholder loans. How to avoid reclassification as dividend. Use a formal note, charge AFR interest, document repayments, and treat the loan as arm's length. You see the theme here, right? 3, selling a business or assets with seller financing. This is big. There's a lot of businesses that sell on asset-based and seller financing, especially small businesses. And the reason being is that small businesses, if they want to sell, this is usually the best form for both parties. Okay. It is a good protective, but the promissory note needs to define interest, payment schedule, a collateral, and installment sales for reporting, tax reporting purposes. And then the 4th one, business lending money to an owner. A note protects you from the IRS questioning. Constructive dividends. unauthorized withdrawals, or misclassified personal expenses. We need to have notes in these areas. So you need to work with your bookkeeping accountant. You can't just go do stuff and just expect your accountant to know everything. This is, again, they're reporting your actions. So it's your responsibility, not theirs. Well, but Bob, I'm not an accountant. No, you're not. But you need to tell your accountant what you're doing so they can classify this correctly. And now you know how you need to have this documentation from a promissory note perspective. Okay. So hopefully this was helpful. I know this may be new to you. But like I've said, there's a lot of times where I've met with business owners and we look at their balance sheet and we see these loans. And the first question I ask when we see these loans, this is part of our audit process. When we take on the bookkeeping and we look at the transactions and the bookkeeping, then we look at the financial statements, and on the balance sheet, we want to look, hey, do you have documentation for these loans? If the answer is no, we need to get documentation. We need to put you can backdate the documentation. You can get the loans in place. You can put the evidence in place, all that fun stuff. You need to document it. It's okay, especially if there is payments that have been had, and it's a real loan, just hasn't been documented. If it's not a real loan and there's no payment or anything like that, then you need to understand how you're going to classify this. Is this really a distribution? Right. And that's what the documentation is supposed to do is to support what you actually are doing, what you're actually doing, not to support your hiding, not to support your deception, but to support what you really are doing. Okay. That's very important as we go through this process. So again, hopefully this was helpful. And again, not the most exciting information, but very, very important information. Very important, especially if you're trying to build your wealth into other areas. Borrowing from one of your assets to create another asset. So if you borrowed equity from a piece of property, real estate, and we see this a lot, borrowing equity from a piece of property or real estate to buy another piece of property, real estate. That new property, both properties should be in a separate LLC for liability purposes. Each of those properties should have an accounting and books according and based on those. And the new property, the one that you just lent money to, should have a payment plan to pay that back, and a promissory note should be in place. Okay? That's what justifies and documents those two. Okay? And rinse and repeat. You borrow from cash value life insurance, same thing. You borrow from your stock portfolio, same thing. Borrow from a 401k, same thing. Okay? Very, very important. Also, at the end of the year, of each year, any interest needs to be charged 1099 to the borrower and needs to be classified as 1099 to the lender. Okay? It is income. This is an area that also gets missed. But I want to pay taxes on the income. Well, okay, then pay taxes on the whole amount as a distribution or as a gift or whatever you're actually doing or not doing. That's the thing. You got to document what you're doing. And if you're documenting what you're doing, then it's better to pay interest on 1099 than have everything reclassified and have that string continually be pulled and your business partner diving into more and more. But if you show that you're trying to be a good business partner, you're documenting everything appropriately, every question that they ask has an answer with documentation, then you're not the low-hanging fruit. All they want to verify, are you doing the things that you're supposed to be doing as a good business partner, and you're not trying to lie, cheat, deceive. That's it. That's all an audit is. Okay? Again, thanks so much for your time. Thank you so much for being a subscriber. If you're not a subscriber, again, click that subscribe button. We drop content every Thursday. Go make it a great day.